Imagine being able to retire and having more of your hard-earned savings stay in your pocket. There are ways that you can create completely tax-free income streams, and today I reveal 6 ways to do it. Here's the catch though. If you don't make these moves, taxes could chip away at your savings year after year, and you could end up withdrawing more than you had planned just to cover the tax hit, possibly running through your funds more quickly than expected. So if I haven't met you yet, my name is Christian Klassen, and I own the retirement planning firm 402 Financial with my business partner Joe, and I created this channel to help you get the most out of your retirement. So what does tax-free income look like, and why does it matter so much in the later stage of life? When you retire, every dollar counts. So instead of giving away your hard-earned money in taxes with tax-free income sources, you get to retain more of your retirement savings. So onto the first source of non-taxable income in retirement. And that's withdrawals from a Roth account, like a Roth IRA or a Roth 401k. So if you meet the requirements of having the account open for at least 5 years and reach the age of 59 and a half, every withdrawal, including the gains you've accumulated, is entirely tax-free. Now don't worry if you don't have a lot in this account, because if you're like most people, you've probably got a lot in pre-tax accounts like 401ks or IRAs. But if you work with us, we can see how taxes may impact your plan a few years out, and we can look at the benefit of what's called a Roth conversion. That's where we take money from a traditional IRA and convert it to a Roth account if it makes sense. And this strategy works extremely well if you're at the point where you stopped receiving a paycheck from work and have not started Social Security yet. Now, the second type of non-taxable income is one many people don't think about, but I've done a video on it previously, so I'll link that in the description, and that's money in a health savings account. So when you use these funds before age 65 for qualified medical expenses, these funds are non-taxable. And that's really the true beauty of an HSA. You get to deduct the money you put into it, it grew tax-free, and when you use it on medical expenses, it's not taxed as well. Now, if you reach age 65, some people think these funds are wasted, and that's not true. Again, go to my other video and I talk about it all there. Now, the third option is municipal bonds, and they are a great option towards tax-free income because normally the revenues from such bonds are exempt from federal taxes. Now, if they're issued by your state, they can be free from state taxes as well. So this makes municipal bonds a relatively strong instrument of tax-free income, especially for conservative investors with a need for predictable income. Now onto the fourth option, and this is for people who are over 70 and a half and are charitably inclined. And the strategy is called qualified charitable contributions. And this lets you donate up to $105,000 annually from your IRA directly to a qualified charity tax-free. And QCDs even count towards your required minimum distribution. So this is a great way to lower your taxable income while supporting causes you care about. This fifth source of non-taxable income really comes into play when you have a non-retirement account or a taxable account or trust account. And so retirees with lower overall income levels can potentially sell investments and stay within that 0% capital gains tax, effectively creating tax-free income. Now this requires careful tax planning and having long-term capital gains, but it can make a pretty big difference in what you keep each year. So if your tax filing status in 2024 is single and you make up to $47,025 of taxable income or less, or if you're married filing jointly and it's up to $94,050 of taxable income or less, you can effectively pay 0% on qualified realized long-term gains. Just make sure you talk to a qualified CPA or advisor before you do anything major here, because it's important to note, realizing capital gains does increase your taxable income. So even though you're taking them at 0%, it's not something just to do without proper planning, which gets me into the last non-taxable income source, and that's about Social Security. As long as your provisional income stays below $25,000 if you're single, or $32,000 if you're married, your Social Security benefits are non-taxable. Now you may be wondering, what is provisional income and how is it calculated? It's a combination of your adjusted gross income, or AGI, any tax-exempt interest you receive, and half of your Social Security benefits. For example, let's consider a married couple, John and Linda. If their combined AGI is $20,000, they receive $5,000 in non-taxable interest, and their combined Social Security benefits are $15,000. We'll calculate their provisional income as follows. AGI is $20,000, non-taxable interest is $5,000, and the Social Security benefits, cut that in half, and that's $7,500. Add that all up, the total provisional income is $32,500. John and Linda's provisional income actually exceeds that $32,000 threshold for married couples, meaning a portion of their Social Security benefits will be taxable. However, by carefully managing these income sources, you can keep your Social Security income completely tax-free if it stays below the threshold, which is really helpful in maximizing your retirement budget. If you like these types of videos on improving your retirement, be sure to subscribe so you don't miss the next video. Also, don't forget to click here for more information on how to maximize your Social Security benefits. And if you haven't yet, check out the in-depth video right here about HSAs and how to maximize that account. If you have any questions, feel free to reach out, or I'll see you in the next video.